The domestic Indian artificial intelligence market is on track to hit $17 billion by 2027. Driven by a 10,000 crore government investment mission, the national equity market is absorbing a massive structural expansion. But if your strategy to capture that growth is to buy shares in a $90 billion IT conglomerate like TCS or Infosys, you are walking into a mathematical trap. Those massive legacy organizations certainly have AI divisions, but their enormous traditional revenue bases severely dilute any actual financial impact from their cutting-edge projects. This chart shows how that math plays out. Look at the proportional impact of a single $100 million AI contract. On a $96 billion market cap, that new revenue barely registers. But applied to an agile $500 million small cap company, that exact same contract effectively doubles their valuation. To identify those high-growth companies, we need a reliable framework. The most accurate way to evaluate the market is to mirror the actual technological architecture of artificial intelligence itself, splitting the sector into three specific pillars. First, physical infrastructure; second, software platforms; and third, implementation services. When we get to the platform layer, you'll see how hyper-specialization works in practice, including an off-the-radar microcap stock building facial recognition networks directly for the government. Generating real returns in this supercycle requires extreme precision. You have to target the exact physical and digital layers of the AI stack, bypassing the bloated legacy brands entirely. Pillar 1 is the digital concrete. The sophisticated algorithms powering predictive data and computer vision require a massive physical foundation of high-performance silicon, specialized networking, and enormous power consumption. The Indian government has mandated a push for sovereign AI. This requires enterprises to keep localized data strictly within the country, creating an immediate, enforced demand for domestic compute clusters. Netweb Technologies step directly into this void. They design and develop advanced AI GPU systems based on NVIDIA's coveted Blackwell platform. By localizing hardware manufacturing, they built a strategic order book worth nearly 1,700 crore. Once the physical servers are built, developers need access to them. Buying high-end computing upfront carries prohibitive capital costs for most organizations. E2E Networks solves this compute bottleneck by offering a fractional, cloud-based GPU model. This chart tracks E2E's financial velocity. You can see a massive 68% year-over-year quarterly revenue spike. Because building infrastructure requires heavy upfront capital, they experience short-term depreciation losses, a classic J-curve. But their explosive hypergrowth rapidly offsets those initial costs as subscription revenues compound. Then we have an entourage. Traditionally a real estate developer, they are converting their existing highly illiquid land banks into high-density, energy-efficient AI data centers. Because they fund this construction using surplus cash from their legacy real estate operations, they are building massive tech infrastructure entirely zero debt. These are the pick-and-shovel providers. The companies pouring the concrete and racking the servers capture the earliest, most guaranteed revenues of the boom, completely independent of which specific software applications ultimately win the market. Moving up the stack, Pillar 2 contains the pure-play software platforms. These companies sell software as a service, or SaaS, meaning they license access to specialized proprietary algorithms. Because the marginal cost to replicate software is near zero, this layer offers the highest profit margins in the ecosystem. MapMyIndia systematically broke Google's mapping monopoly in the Indian enterprise sector. They use advanced machine learning engines to process real-time predictive traffic data and build high-definition maps, securing a 95% market share in the Indian in-dash automotive navigation space. In the hospitality sector, RateGain manages pricing for 33 of the top 40 global hotel chains. They achieved this by deploying agentic AI, systems that execute autonomous actions rather than merely providing analytical recommendations, to instantly optimize room rates across the globe. In digital advertising, Affle India utilizes real-time predictive algorithms to eliminate ad fraud. They analyze massive datasets across 3.6 billion connected devices, guaranteeing that their clients only pay for measurable, successful conversions. And then we have the microcap anomaly, rnt.ai solutions. Operating in the business-to-government, or B2G space, they provide the algorithmic backbone for state security. They are an approved vendor for secure government facial recognition networks, having processed over 3 billion identity verifications. This scale weighs the extreme risk-reward paradox of RNIT's financials. On one side, they boast a 62.7% return on capital employed, showing incredibly efficient profitability. On the other side, they suffer a 163-day debtor cycle, struggling against notoriously slow government payment systems. Owning a proprietary algorithm that actually solves a massive enterprise or government problem creates a virtually insurmountable competitive moat, scaling exponentially without needing physical assets. Finally, Pillar 3 focuses on the implementers. Foundational models make great headlines, but legacy enterprises need specialized human engineering to actually install those models into their daily workflows. The traditional model of offshoring basic maintenance to cheaper labor pools is dead. This chart demonstrates the raw profitability of specialized engineering. K-Solves India deploys generative AI architecture for global clients. Operating with virtually zero debt, they command a staggering 143% return on equity, meaning they are incredibly efficient at turning investment into hard profit. Socksoft accelerates digital modernization through a highly effective acquisition strategy. They consistently buy up specialized niche AI talent to expand their geographic footprint, carefully absorbing $10 to $15 million companies without destroying their internal corporate balance sheet. Our systems caters directly to Fortune 500 companies rushing to build global capability centers, essentially captive in-house tech hubs located in India. Using proprietary AI-assisted playbooks, our systems allow these massive corporations to launch fully operational hubs in under 90 days. Agile mid-cap IT firms are highly profitable right now because they replaced the outdated labor arbitrage model with high-margin AI digital engineering, capturing significantly higher billing rates along the way. This diagram shows the complete reality of the market. The physical infrastructure, the algorithmic platforms, and the specialized implementation services rely entirely on one another to function. You cannot scale SaaS platforms without data centers, and legacy companies cannot use those platforms without agile IT integrators. The global AI narrative has firmly moved away from experimental model training in North America. We have definitively entered the deployment cycle, and it is being aggressively driven by specialized Indian engineering. The era of relying on massive IT conglomerates to provide safe, steady portfolio growth is over. Their structural size is now an active barrier to exponential returns. As you audit your own capital allocation for the next decade, you have to look at the math and ask yourself, in this deployment cycle, are you holding sluggish cargo ships or agile speedboats?